Rating agencies. So we've made some casual references to the rating agencies. How do we expect rating agencies to respond? How quickly do we expect downgrades? And what are the trends in credit spreads and investment grade and non-investment grade names?
I think there's going to be a big slew of downgrades coming very fast because for a couple of reasons. A, they've been accused of reacting too slowly, so they're going to have to react faster. And people don't realize that the number I show my classes is that there's investment grade and there's investment grade. If you look at the difference in the default risk over a 10-year period between a triple B plus and a triple B minus, I asked my class this. I said, what do you think that difference in default risk is? They said, oh, maybe 20 or 30%. Over a 10-year period, the difference in expected default rate between a triple B plus and a triple B minus is 250 to 300%. So not all triple Bs are created equally. So once you get to that final level of detail, and as an analyst, you should get a credit analyst, you can't just lump triple Bs together because there's a tremendous difference in the expected default probability of something as simple as that.
And that's a very, very good point. And I've seen related statistics to that as well. I mean, it's like falling off a cliff, so to speak.
Yeah.
Once you dared to get into the triple Cs, and the cliff is even steeper at that point in time.
And I think once you get into single Bs, triple Cs, people know you're buying dicey stuff. I think there's a little bit of a false sense of security. Well, I'm in triple B land. Triple B land has a lot of gamma.
Yeah, exactly. Now, I do like what you're also saying. It's very good to point out is that rating agencies are being watched. They watch companies, but they're being watched after the crisis. They were blamed for being too slow when we're talking about financial institutions in the mid-2000s. And so we are now in a post-crisis environment. Regulators are supervised by the SEC.
Now,
and then there's some expectations about them, about what they should.
I'm much less concerned about the rating agencies in this cycle because it's about rating corporates, which they've been doing for a long, long time since that first railroad bond in 19 whatever that they did. The problem during the 2009 crisis, they were rating subprime mortgages where they had no history of. Okay, so that was the big issue with regard to the ratings for subprime, CDOs and all that sort of thing. They had no history to draw on. At the very least, you want to have a couple of economic cycles to actually create your expected loss tables. They didn't have it because that subprime didn't exist. If you go back 30 or 40 years, it was Household Finance was the only subprime company in the world.
Yeah.
And I think, Tracy, we're of similar vintages, I think, so we remember that.
Exactly.
So when they first started rating subprime, they didn't. Their rating structure was not based on history because there was no history, and
based on a lot of models.
Exactly. Whereas historically, if you look at the ratings for corporates, it's based on looking at ratios for history of ratios and that sort of thing. And they can sit there and say, okay, over a 5-year period, a cohort of companies with these type of financial ratios has an expected default rate of X, Y, or Z. So what I'm saying is that because the ratings downgrades that we're expecting for corporates is based on 100 years of history, give or take. I don't see that there's going to be a lot of pressure on rating agencies, making wrong decisions. They just have to act fast.
I think that's a very important that you bring up. So at the same time, as you say, some of the flaws were in the structured products, subprime mortgages, and things like that they had, sort of overrating some of these debt issues at that point in time. I still think that at the same time, because of the attention they garnered back in the crisis, people will still continue to watch how they're going to respond to corporates. So, but I think it's going to be a better rating process than before, partly because of the guidelines and supervision that they do fall under today.
Yeah, but again, I think the key point is that they could be rating corporates. This is their strength. This is their experience.
The other thing is that sometimes when I look at rating agencies, I don't necessarily look at the rating. I also try to get some insight from them as well. So as a credit analyst or financial analyst, sometimes they provide insight. They sometimes bring out a point of view or an aspect of the analysis that we may not have conventionally looked at. So there's always benefit to kind of hear their voice to see what they're thinking of. What we also know about rating agencies is that credit markets, equity markets, they respond to bad news right away. Rating agencies go through a methodical process. And I think, as you had said, you're going to see some downgrades, but it's going to be a methodical, well-reasoned downgrade.
Yeah, definitely.
Now, what rating agencies do, also, of course, if a company is an A, it looks like a triple B, looks like a double B, they're not going to downgrade it tomorrow. What they will do is they will express an outlook or put it on a negative watch list. And so it's always good to see what companies are on those watch lists. They're candidates for downgrades.
Yeah, as we used to say in the trading world, hold means sell, right?
Yeah, yes.
Now, I think the other thing to think about is that the rap about rating agencies is they're always assigning ratings based on the history of a company. There's no quantitative forward-looking aspect to their ratings per se. So I think there's some new companies trying to incorporate some forward-looking aspects. If you look at Moody's bought KMV a couple of years ago, which is kind of an options-based market expectations to distance to default, and again using equity markets as a factor for predicting defaults also. So not just looking at historicals. So I think they're trying to figure it out a little bit more instead of just looking out life through the rearview mirror.
That's correct. And the thing about it is, I think within the rating agency, they may have a view and they may have a perspective, but sometimes they're very, very cautious of how they express that publicly. Yeah. You also mentioned KMV. So that's a KMV model, and it can be used to sort of extract or derive a credit rating based on volatility in equity markets. Do you have any thoughts about that particular model? It's a widely discussed and widely used model.
When I was still in the industry, and I've been out since 2011, so I haven't really kept up with who's been using what per se in that space. But that was probably the leading model at that time during the early 2000s.
The thing about the model is that banks under the Federal Reserve and Basel III guidelines are not allowed to use that to make credit decisions. They can use it to be advised and gain insight, but they're not allowed to use it to rate corporate borrowers. What I like about KMV is that it does evolve and change. And what I noticed is it has a better track record in sort of predicting default than some of us might think. It actually does have a fairly...
It reminds me of one of my favorite books, The Wisdom of Crowds. If you get enough diverse opinions coming in, which is the diverse opinions about people investing in the stock market, there may be a good indication there.
That's correct. Absolutely. Question number 6. This is our final question, and we've kind of alluded to this already. What industries are most vulnerable, are most at risk, and will require a significant amount of analytical attention? And what are the industries that could potentially thrive? When we think of vulnerable industries, of course, we think of those are the ones that are candidates for downgrades in the short term. Those are the ones that are going to have trouble in managing and servicing debts that's due over the next couple of years. I list some of the obvious, and Jerome, are there some other industries that?
Yeah, I think durable goods falls under less vulnerable. The challenge becomes, for companies which are based on the service industry, if the stay-at-home rules stay for another 2 or 3 months, whatever the number is, it'll still take some while before people come back to the levels they were before, just being comfortable in large crowds, whether it's going to be a sporting event or a restaurant or what have you. So it's not going to be an immediate snap back to where it was before, because if you're older, you might still be vulnerable. And once you do go back, if it's been 4 or 5 months, you're not gonna go out and make up for those times you didn't go out for the last 4 or 5 months. So that that revenue is lost forever.
Yeah, yeah.
If you go buy a washing machine or car, I'm deferring that, but I'm still going to go get that washing machine and car. So I think on the durable goods side, the pent up demand will manifest itself with a buying spree, when things let up. But,
Yes.
again, I'm not going to go watch 3 times as many movies once the ban is lifted, because I'm sorry, the movies aren't that good, number one.
Yeah.
And the same with going with hotels on vacations. I'm not going to go 3 times as many vacations after the bans are lifted. So those, there's going to be holes in their balance sheets for a long time.
And I like that because, I've been looking at a lot of analytical reports, whether it's debt or equity, about who's vulnerable and who's not vulnerable. But you make up a very good point, a phrase, pent up demand. And so at some point when we've kind of gotten through this crisis, they can benefit, as you said, it is pent up demand. So he or she who needs to buy a car, and they got to have a car,
Right.
They're not going to buy it next week, but a year from now, everybody who needed a car is going to be out there buying a car. So that's almost safe to say we need to segment that part of the corporate industries as well.
So, the pent up demand for going to restaurants is just going back to where it was before at some level.
That's correct.
There's no overshooting to
That's
compensate
correct.
for what was, I didn't get to go out for the last 3 months or 4 months.
You mentioned the entertainment and movie streaming. One of the companies that provides much of that streaming in bulk is Netflix, and that's a company that has piled on a significant amount of debt, $15 billion over the years. So in my NYIF classes, we have looked at that as a special case to the extent that can it manage that debt. Now, Netflix is actually a non-investment grade name, and it's experiencing a good time right now. But the issue that rating agencies have had is that could they continue to be able to service that debt over the long term? I have no question that they will be able to pay interest, but as debt becomes due, can they refinance it? And the thing about a company like Netflix is that that's part of their operating model. I need to develop more content, so therefore I need to take on more debt.
Yeah, they were the first media, the first, I guess what I call, infrastructure company or piping company which actually understood that content is king versus just building pipes.
Yeah.
So if you look at what Disney's doing with the Disney Now or whatever that is, I don't have young kids, so I don't even know the name of that new product that came out a couple of months ago, or even a month ago.
Yeah.
So they're particularly in a tough spot because look at all the whole hotel industry, and what they're expanding into is the online streaming, which is already a very crowded space between Amazon and Hulu and obviously Netflix and everyone else also. So if you look at they're trying to diversify and expand in the streaming spaces, they're expanding into a crowded space.
That's correct.
They have some good brands, so they'll probably get their fair share. But how much can you really grow with that?
Yeah, and I bring up companies like Disney and Netflix or any streaming companies because everybody's there's the perception that they're experiencing a boom. But if you're experiencing a boom and you have substantial amount of debt and you got to keep up with customer taste, you got to produce more content, then at some point you can say, how are we going to manage these piles of debt? At the bottom of this particular slide, I put here what some people are familiar with is the Porter model.
Yep.
There are pros and cons about that particular model, but as we look at companies going forward, it always helps. It sort of sums up many things that we've been talking about today, is look at the company in the context of its business, its industry, who its customers are, who its suppliers are, and who its competition is. So, this is just sort of, we need to rethink company by company, industry and industry, how that company interfaces with these stakeholders or other influencers.
Yeah, I mean, you mentioned Netflix. The question is, since the crisis began, how many new subscribers do they have versus just existing subscribers which use the service more, which they get no additional revenue from?
Yeah, and that's a very, very good point. And it appeared that Netflix had had begun to sort of reach its peak in terms of subscriber growth. They may have an incremental small growth. It's
Yeah.
just that what you might be seeing now is that the same users are now using it.
Exactly, right? Before they were busy working.
Yeah. So I just sort of say, whether it's a vulnerable industry or less vulnerable industry, I think that as we look at highly leveraged balance sheets, cash on the balance sheet, cash flows, debt levels, debt metrics, support from banks, access to debt markets, it also comes back to, let's look at that business model and to kind of understand these special risks that the company faces within the business model. Any other thoughts as we sort of wind up our questions?
You know, I would just leave off, if you look at just kind of the oil and gas industry, and given that, before the crisis and probably now we're still the largest producer in the world, but we have a lot of high cost producers in the shale space.
Yeah.
And we'll kind of see how that kind of shakes out to see if they can survive or not.
Yeah,
A lot of them will go under because they're highly leveraged. And then, kind of look at the geopolitical issues between Russia and OPEC to see how much of that is inflicting damage on the oil and gas sector, especially on the high yield side.
And one thing that I'll be looking at over the next several weeks is that banks, the first quarter is over, so banks will start reporting their first quarter numbers and first quarter balance sheets. And so it'll be interesting to look at their loan portfolios by industry, by country, and by currency to see where there could be vulnerable. You talked about the oil and gas industry. What percentage of the loan portfolios in oil and gas? We've talked about and highlighted vulnerable industries as hospitality and transportation and automotive. What percentage of their loan portfolios are in those industries as well? So, I mean, those are the ones that, as I say, as we are sort of summarizing, are the ones that could be facing a crisis of their own if they're not prepared with stronger balance sheets.
Mm-hmm.
Okay.
Last word?
No, I think, if you look at keeping an eye on, see how the quantitative easing helps out or not to support prices for fixed income products, that's something to watch also. See how that program goes.
And then also to see what extent that companies that are in some of these identified vulnerable industries and are candidates for support from the federal stimulus, to see how they use it and see how it really helps, at least in the over the next 6 months.
Yeah, and the other saying that I always used to like is like, you don't want to catch a falling knife for industries that are going to go down. Adding additional support is just throwing money down the drain potentially.
All right, thank you, gentlemen. Any last and final thoughts?
Stay safe, eat well, exercise. That's the best you can do.
All right, thank you, Jerome and Tracy.
I concur.